January 28, 2021, Menlo Park, California. The glow of computer monitors illuminates the sweat on the faces of executives at Robinhood. It is 3 a.m, and the most popular trading app in the world is effectively bankrupt. The phones are dead silent, but the servers are screaming. A single automated email has just arrived from a windowless building in Lower Manhattan, demanding $3 billion by 10 a.m. If they do not pay, they will be disconnected from the global financial system. But there is a paradox here. Robinhood is drowning in retail cash. Millions of users are pouring billions of dollars into meme stocks like GameStop and AMC. By all conventional logic, the broker should be swimming in capital. Instead, they are staring down the barrel of a margin call so massive it threatens to wipe them out before the sun comes up. The public thinks the villains are hedge funds in penthouses, smoking cigars and conspiring to shut down the little guy. They are wrong. The executioner is a faceless, unelected utility company that processes $2.5 quadrillion a year. Welcome to the machine. Let us recreate that early morning phone call. Imagine the screen split in two. On the left, a panicked broker in California. On the right, a cold, automated risk engine in New York. The broker says, "My users just placed 1 million buy orders for GameStop. We need you to clear these trades." The machine replies, "I see your orders, but this stock is too volatile. If you default before these trades settle in 2 days, I am on the hook. To protect the casino, you must post $3 billion in collateral right now." The broker says, "We only have 700 million. The machine states coldly, "Then you cannot buy any more. Restrict the trading, lower your risk, or you are shut down." This is the conversation that halted the greatest retail uprising in history. It had nothing to do with protecting hedge funds and everything to do with protecting the plumbing. If you want to stop getting played by the market, you need to understand this plumbing. Hit subscribe to join the few who look past the ticker tape and study the gears. Because right now, your brokerage app is lying to you. Open your portfolio app. Look at those shares of Apple or Tesla sitting there. Now, imagine a giant red stamp slamming over your phone screen with the words, "Beneficial interest only." You do not legally own those shares. Legally, they are immobilized inside a massive electronic vault called the Depository Trust Company, or DTC. The registered owner on the official corporate books is a shell entity named Seed & Company. Seed & Company is the nominee for the DTC. When you click Buy, you are not buying a piece of paper with your name on it. You are buying an electronic IOU, a claim on a position that your broker holds at the DTC. It is a nested doll of ownership. You hold a claim against your broker. Your broker holds a claim against the DTC. And the DTC holds the actual electronic certificates for roughly $100 trillion in global assets. It is the central warehouse for United States securities. Every dividend, every stock split, every proxy vote flows downward from this single central node. And for decades, retail investors had no idea this vault even existed. Why would the entire American economy surrender its ownership records to a single private utility? The answer is that holding the certificates is just the storage component. Tracking $100 trillion in wealth is useless if you cannot process the daily movement of that wealth. As trading speeds increased, Wall Street realized that the vault was not enough to keep the system alive. They needed an active engine, a master clearinghouse that could stand in the middle of every single trade and act as the ultimate guarantor. A casino manager that took on the risk of every player at the table. To do this, they created the National Securities Clearing Corporation, or NSCC. Together with the vault, This formed the Depository Trust and Clearing Corporation, the DTCC, a shadow giant that processes an incomprehensible $2.5 quadrillion a year. But holding the wealth is entirely different from moving it. Before we look at how this machine was originally constructed, we must step inside the engine room today to understand the mathematical illusion that allows quadrillions of dollars to squeeze through the narrow pipes of the banking system without blowing them up. Present day, New Jersey. Deep inside a nondescript data center, rows of black server racks hum with deafening intensity. There are no paper certificates here, no shouting brokers, just fiber optic cables processing over 25 billion messages a year. This is the beating heart of the casino, the National Securities Clearing Corporation. Every time you open your phone and hit buy on a stock, a signal beams into this fortress. To you, the trade looks instantaneous. A green notification pops up, and you assume the transaction is finished. But behind the firewall, a massive, hidden machinery is just waking up. For the next 2 days, you are floating in a state of financial limbo. The casino has acknowledged your bet, but the chips have not actually moved. The DTCC is now acting as the universal middleman, stepping between your broker and the market maker who sold you the shares. It is a legal sleight of hand called novation. The clearinghouse becomes the buyer to every seller and the seller to every buyer. By guaranteeing both sides of the trade, they ensure that if a broker goes bankrupt tonight, the market survives tomorrow. Let us break down this novation using a hypothetical dialogue. Picture 3 men at a poker table: the retail broker, the market maker, and the casino manager who represents the DTCC. The broker says, "My client wants to buy 100 shares of Apple. Here is the cash." The market maker says, "I will sell those shares, but I do not trust you to actually deliver the money." The casino manager slams his hand on the table and says, "Stop! Do not look at each other. Both of you look at me." Broker, you owe me the cash. Market maker, you owe me the shares. I personally guarantee that both of you will get what you are owed, even if one of you drops dead before the trade settles. This is the magic of the central counterparty. The participants do not need to trust each other. They only need to trust the casino. But taking on the risk of every single trade in the American stock market requires an astronomical amount of capital. If the casino had to settle every single bet one by one, the sheer volume of cash required would bankrupt the global economy. To survive this immense volume, the DTCC uses a mechanism called multilateral netting. Imagine a massive whiteboard where a mathematician is frantically erasing numbers. Over the course of a trading day, a major broker might buy $10 billion worth of stock, but they also might sell $9.9 billion worth of stock. Instead of forcing the broker to send $10 billion in cash and receive $9.9 billion back in a million separate transactions, the DTCC simply calculates the net difference at the end of the day. They wipe the board clean and say, "You only owe us $100 million. This netting process is a financial miracle. It reduces the total value of payments that need to be exchanged by a staggering 98% every single day. That $2.5 quadrillion annual figure is squeezed down into a tiny fraction of actual cash movement. It is the ultimate efficiency engine, turning a raging river of chaotic transactions into a calm, predictable stream of end-of-day settlements. But this efficiency relies on one critical assumption. It assumes the market behaves rationally and predictably. The netting engine is a masterpiece of financial engineering during times of peace. But it harbors a dormant systemic vulnerability. Between the moment you click buy and the moment the trade actually settles days later, the casino is entirely exposed to counterparty risk. If millions of people suddenly decide to buy a dying video game retailer, the clean math of multilateral netting violently breaks down. The risk skyrockets. But why did Wall Street build such a centralized, fragile choke point in the first place? Why force every single trade in the American economy through one specific server farm in New Jersey? The system was not designed to steal from retail traders. It was designed out of absolute existential panic. To understand why the modern market operates like a heavily fortified casino, we have to travel back in time, away from the server racks, and look at the disease that almost killed capitalism before computers even existed. We must go back to the moment Wall Street suffocated on its own success. New York City, 1968. The air in the brokerage back offices is thick with cigarette smoke and desperation. Picture a sea of desks piled high with thousands of paper stock certificates slipping onto the floor, getting mixed up in trash cans. Messengers, known as runners, are sprinting between bank buildings with duffel bags stuffed with millions of dollars in negotiable securities. Wall Street is physically choking to death. Trading volume has spiked to a staggering 12 million shares a day, a number that seems quaint now, but was apocalyptic then. The paperwork backlog is so severe that brokerages are forced into an unprecedented surrender. They shut down the New York Stock Exchange every single Wednesday just to let the clerks try to match the buyers with the sellers. Millions of dollars in dividends are being mailed to the wrong addresses. Organized crime is literally stealing bags of stock certificates off the streets. The New York Attorney General issues a warning that the entire financial industry is on the verge of a catastrophic operational collapse. They had to invent a machine to swallow the paper, or the American market was going to grind to a halt. Listen to the conversations happening in those smoke-filled rooms. Broker A calls Broker B and shouts, "I bought 10,000 shares of IBM from you last Tuesday. Where is the paper?" Broker B yells back, "My runner dropped it off at your clearing bank yesterday. Go check the vault." Broker A replies, "The vault is full of unfiled bags. We have no idea who owns what anymore." It was a game of financial musical chairs played with physical paper, and the music was speeding up. To solve this, the banking elite realized they could not keep moving the paper around the city. They had to freeze it. The bankers said, "What if we put every single stock certificate in one giant room and we never let them leave? Instead of moving the paper, we just change the names on an electronic ledger." This single conversation birthed the central depository concept. By immobilizing the certificates in one central location, the physical street-level chaos was instantly digitized into a clean, centralized database. But holding the certificates was only the first step to survival. Imagine a massive, fortified, subterranean room. Over time, virtually every publicly traded company in America was forced to deposit their physical shares here. To make the accounting work, the depository created a proxy, the ghost entity named Seed and Company. By registering all the shares under this one nominee, they could transfer ownership between brokers electronically without ever touching a piece of paper. If Merrill Lynch sold to Goldman Sachs, a computer simply debited one account and credited another. The paper in the vault never moved an inch. This mechanism is called immobilization, and it became the bedrock of modern finance. It is a brilliant, highly efficient system that saved the markets from burying themselves alive. But a vault is just a storage unit. As electronic trading exploded in the decades that followed the 1968 crisis, Wall Street needed something much faster. The sheer volume of transactions meant that simply tracking ownership was not enough to prevent a systemic collapse if a major bank failed. They needed the netting engine, the central counterparty that we discussed earlier. They needed the casino. By fusing the vault with the netting engine, the Depository Trust and Clearing Corporation was officially born. The paper crisis was solved. The markets could now handle billions of shares a day, executing trades at the speed of light. But the architects of this system had made a dangerous trade-off. By eliminating the street-level chaos of physical paper, they had concentrated all of the risk into a single point of failure. When you force every trade through one centralized casino, you create a mathematical time bomb. The clearinghouse is perfectly safe as long as the market is calm. But if a massive, unexpected wave of volatility hits the system, the casino is legally obligated to protect itself first, even if it means destroying the very brokers who feed it. For decades, this mathematical time bomb ticked quietly in the background, unnoticed by the general public. Until the winter of 2021, when a group of retail traders on the internet accidentally discovered the detonator. Late January 2021. The DTCC Risk Management Center in Lower Manhattan. Imagine a massive digital dashboard covering an entire wall. Normally, this board displays a soothing sea of green, indicating that the thousands of brokerages in the system have enough cash to cover their daily trades. But today, a cluster of alarms is flashing violently red. A handful of highly concentrated meme stocks, primarily GameStop and AMC, are experiencing volatility that defies all historical models. The settlement window, the 2-day gap between execution and final payment, has suddenly become a minefield. The risk managers stare at the screens in disbelief as the exposure metrics climb into the billions. The system is operating exactly as designed, but the inputs are breaking the scale. Retail brokers, fueled by viral internet campaigns, are funneling massive, one-sided buy orders into the market. Because the orders are not balanced with sells, the magical 98% netting reduction is completely failing. The brokers are building up massive, unhedged settlement obligations. The DTCC algorithm calculates the potential loss if these brokers were to fail before the 2 days are up. Listen to the automated dialogue happening between the computers. The risk engine scans Robinhood's portfolio and says, "You are flooding the zone with massive buy orders for incredibly volatile stocks. Your risk profile has just exceeded your safety parameters." The brokerage system replies, "We are just routing client orders. We have $700 million on deposit in your clearing fund. We are fine." The risk engine recalculates and says, "No. 700 million was for yesterday. Today, the mathematical probability of a catastrophic default has spiked. Under the rules of the National Securities Clearing Corporation, I am applying a value-at-risk multiplier and adding a massive excess capital premium charge to your account." The brokerage system flashes an error code and asks, "How much do we owe?" The risk engine responds with terrifying precision. "To open for trading tomorrow morning, you must wire $3 billion into our vault immediately. If the cash is not there, your connection to the market will be severed. You will not be allowed to clear a single trade. It is a digital ultimatum." To understand this massive margin call, visualize a seesaw. On one side, you have the value of the stocks being traded. On the other side, you have the cash collateral the broker must lock in the DTCC clearing fund. During normal market conditions, the seesaw is balanced. But when a stock like GameStop goes parabolic, the DTCC risk models flag it as a systemic danger. The formula is primarily based on value at risk, or VAR. It calculates the maximum possible loss the clearinghouse could suffer over the 2-day settlement period if the broker defaults. Because Robinhood's customers were almost entirely buying rather than selling, there was no netting to offset the risk. Furthermore, the DTCC applies an excess capital premium charge if a broker's VAR requirement exceeds its net capital. It is a punitive fee designed to discourage brokers from taking on dangerous levels of concentrated risk. By 10 in the morning on that fateful Thursday, the algorithm had determined that Robinhood's exposure was a threat to the broader financial ecosystem. The $3 billion demand was not a suggestion. The cliffhanger of this mathematical absolute is that it forces an impossible choice. The clearinghouse does not care about retail revolutions or democratizing finance. It only cares about counterparty risk and ensuring that the $2.5 quadrillion machine does not grind to a halt. When that $3 billion demand hit Robinhood's servers, it created an existential crisis. The broker did not have the cash. Raising $3 billion in a few hours before the market opens is virtually impossible, even for a Silicon Valley darling. The executives were staring at the very real possibility of a total operational shutdown. If they defaulted, the DTCC would step in, liquidate their positions, and the contagion could spread across Wall Street. The executives had only one card left to play. They could not change the rules of the casino, but they could manipulate the mathematical inputs of the risk engine. If the problem was a massive influx of buy orders driving up the collateral requirement, the solution was brutal but obvious. They had to kill the buy button. The stage was set for a disaster. January 28, 2021, 5 in the morning, California. The executive team at Robinhood is frantically dialing the clearinghouse in New York. The sun has not even risen, and they are begging for their lives. Imagine the tension in the room. Lawyers and engineers are pulling up the DTCC rulebooks, looking for a loophole, a waiver, anything to lower the crushing $3 billion demand. The automated excess capital premium charge makes up more than $2 billion of that total alone. The executives know that if they open the app to the public at 9:30, the retail swarm will immediately trigger millions of new buy orders, pushing the collateral requirement even higher. It is a death spiral. They are trapped between their rabid user base and the cold, unyielding wall of the settlement plumbing. A decision is made that will permanently shatter the trust of a generation of investors. They will actively restrict trading on GameStop, AMC, and a handful of other volatile tickers. They will allow users to sell, but they will completely disable the ability to buy. It is an act of financial amputation. Let us translate those frantic pre-market phone calls into a clear dialogue. The Robinhood executive says, "We cannot post $3 billion today. If you enforce this, we are bankrupt." The DTCC official replies, "We do not want to blow you up, but we cannot absorb your risk. The formula is the formula. Reduce your risk profile and the algorithm will reduce your margin." The executive asks, "If we shut down all buy orders on these specific meme stocks, taking our concentrated exposure down to zero, will you waive the excess premium charge?" The official consults the risk engine and says, "If you restrict the buys, your value at risk drops significantly. We will waive the $2 billion premium, but you still owe us the standard collateral for what is already on the books. Post $700 million, restrict the trading, and we will let you open." The deal is struck. By disabling the buy button, the broker manipulated the math to survive the margin call. The casino allowed them to stay at the table, but only after they agreed to stop placing the bets. This mechanism of survival is widely misunderstood by the public. Imagine a massive pressure valve on a steam pipe. When the pressure gets too high, you have to turn the valve to release it, or the whole factory explodes. Turning off the buy button was Robinhood manually shutting the valve. By only allowing users to sell, the broker shifted its net settlement position. Sells generate cash coming into the broker, which actually reduces the collateral required by the clearinghouse. It is a mechanical necessity, not a darkroom conspiracy. The DTCC rules explicitly allow them to demand 100% collateral on trades that pose a systemic threat. By halting the buys, the massive wave of retail capital was suddenly blocked from entering the market, causing the price of the meme stocks to violently crash. The hedge funds who were shorting the stock certainly benefited from this crash, which fueled the conspiracy theories. But the trigger was pulled by the clearinghouse's risk management engine. The system worked exactly as designed, to contain a localized fire before it could burn down the entire $2.5 quadrillion neighborhood. The aftermath of that morning left millions of retail traders furious and disillusioned. They had discovered, the hard way, that clicking buy on an app does not grant you instant power. The illusion of a free and frictionless market was shattered, revealing the heavily fortified plumbing underneath. Congressional hearings were held, executives were dragged before cameras, and the public demanded answers. But the DTCC quietly faded back into the shadows. The politicians focused their rage on the brokers and the hedge funds, largely ignoring the giant vault that actually controls the mechanics of the market. However, inside the halls of the regulators, the alarm bells never stopped ringing. The SEC realized that the 2-day gap between a trade and its settlement was a massive systemic vulnerability. The GameStop saga proved that in the age of viral algorithmic trading, a 48-hour waiting period is an eternity. It is enough time for a broker to collapse and take the clearinghouse with it. The regulators decreed that the plumbing had to be upgraded. The settlement window had to be compressed. The era of the 2-day settlement was over. May 28, 2024. Wall Street. The atmosphere in the back offices is a mix of exhaustion and high alert. The clocks have been pushed forward. Decades after the paper crisis forced the creation of the vault, the Securities and Exchange Commission has mandated the most significant upgrade to the financial plumbing in a generation. The transition to T+1 settlement. Imagine a giant hourglass where half the sand has suddenly been removed. Traders no longer have 2 days to locate the cash and the securities to finalize their bets. They have one single business day. The massive server farms at the DTCC have been reconfigured to process the trillions of dollars at double the speed. For the retail investor, the change is invisible. The app looks the same. But for the institutional machines, it is a brutal compression of time. The goal is simple: reduce the time, reduce the risk. A shorter window means less time for a stock to experience a violent GameStop-style price swing before the cash changes hands. The clearinghouse needs less margin, and the threat is cut in half. Or so the theory goes. Listen to the new dialogue echoing through the boardrooms as this rule takes effect. The SEC regulator says, "We have compressed the settlement cycle. By cutting the time in half, we have lowered the counterparty risk. The next time a meme stock explodes, the clearinghouse will not need to demand a $3 billion margin call." The bank executive shakes his head and replies, "You did not eliminate the risk, you just moved it. Yes, the clearing margin is lower, but now we have half the time to locate the billions of dollars in cash needed to settle the trades." The regulator says, "Our models show this makes the system safer." The executive fires back, "Your models assume perfect liquidity. What happens when a foreign investor sells a massive equity position, but their currency exchange does not clear in time for T+1? We are going to see a massive spike in trade failures. You have solved the margin problem by creating a severe intraday liquidity problem. The plumbing is running faster, but the pipes are under immense pressure. One tiny blockage and the cash will stop flowing." This liquidity squeeze is the hidden mechanism of T+1. Picture a high-speed train hurtling down a track. Moving faster gets you to the destination quicker and reduces the time you're exposed to a derailment. But running the engine at that speed requires a massive, uninterrupted flow of fuel. In the financial system, that fuel is intraday liquidity, cash that is available right this second. Global institutions must now synchronize their foreign exchange trades, their securities lending, and their cross-border cash movements in a fraction of the time. If a European fund buys an American stock, the time zones work against them. If the cash is not lined up by the strict DTCC cutoff times, the trade fails. A failed trade means the central counterparty is left holding the bag, which triggers the exact same risk management alarms that went off during GameStop. The DTCC has explored blockchain and tokenization to make this even faster, dreaming of real-time settlement. But real-time settlement requires real-time cash, and the global banking system simply does not have trillions of dollars in idle cash sitting around waiting. This brings us to the chilling reality of the modern market. The $2.5 quadrillion vault is more powerful and faster than it has ever been. By compressing the settlement window to protect the casino from the players, the system has become hyper-optimized but dangerously fragile. The safety buffers have been stripped away. The next financial crisis will not look like the housing crash, and it will not look like the GameStop margin call. It will be a silent, instantaneous liquidity freeze. A moment where the algorithmic pipes of the DTCC demand billions in immediate cash from a bank that simply cannot wire it fast enough. When that happens, the netting engine will stall, the fails will cascade, and the ultimate shadow giant will violently disconnect the players from the table. You do not legally own your shares, and you do not control the plumbing. But understanding this machine is your only defense against it. If you want to survive the next time the vault locks its doors, you need to see the gears turning beneath the screen. Subscribe to this channel and never trade blind again.